Whitney here. Welcome to the Passive Investing Made Simple Bootcamp. I'm your host, Whitney Elkins-Hutten, the Director of Investor Education here at PassiveInvesting.com. And we do these monthly boot camps to help you learn and deep dive into a skill that you can put to use in evaluating passive deals, maybe even building out your vetting processes, but also just mostly so you can go into your next deal with confidence. So if you haven't done so already, make sure to join us at PassiveInvestingWithWhitney.com. There you can get access to our future boot camps, as well as see our open deals. And if you'd like, jump on a one-on-one call with me. Now, while we're waiting for people to file in the room here, I'm just really excited to be joined today with our Director of Acquisitions, Eric Fitzgerald. Eric, you want to say hi?
Hi, Whitney. Thanks for having me. Hey, everybody. Glad to be here.
Yeah. Well, guys, this is a little bit different than our masterclass sessions where we kind of like reproduce those into a podcast. This in the boot camp, this is meant to be interactive. So I want you guys to go ahead and go down to the bottom of your Zoom bar. I want you to find your Q&A box and let Eric and I know where you're joining in from. This will also be the place that you will drop in your questions as we deep dive into today's topic, learning the ins and outs of the sensitivity analysis. Okay, we're not going to just stop at what a sensitivity analysis is, why it's important. We're going to actually show you how to find it, how to read it, and then also various ways that it can be manipulated that you're going to want to watch out for. So drop down into the Q&A box again. Oh, joining from Northwest Georgia. Fantastic. Myself, I'm joining from Colorado. Eric, where are you in the world today?
I'm in Charlotte, North Carolina. Oh, I see we have a Paris, France
Awesome.
there. That might be the coolest one I've seen so far.
I know, right? I'm coming to you, Carlos. Coming to you. And it's gotta be pretty late at night. See, dedication to learning and broadening your education in this space. All right, guys, let's dive in here today. Well, first, actually, Eric, I would love for you just to kind of give us a little bit of highlight on what you do here at PassiveInvesting.com as the Director of Acquisitions, and how you got into the space.
Yeah, thanks, Whitney. So like Whitney said, my name is Eric Fitzgerald. I head up acquisitions for PassiveInvesting.com. I've been with the company almost 3 years now. Been really fortunate to have seen a lot of growth in these last couple of years. We've done about $1.2, $1.3 billion worth of transactions in that time. So love what I do, love my team. We've got a great team of 5 people on my acquisitions team now. And that's been an awesome way to see the company grow in that way as well. My background, I started in property management originally when I was in college. Kind of learned all about real estate through kind of starting at the ground level at some properties, and moved to Charlotte, worked as an analyst for a multifamily firm. I did a 12 unit with 2 partners here in Charlotte as well. And then got a job with a family office doing acquisitions, and then linked up with the guys at PassiveInvesting.com, like I said, about 3 years ago. So happy to be here, and hopefully we can add some value here today.
Yeah. And I just want to put it in context. I know Eric shared that, he has been participating in 1.2, 1.3 billion of those transactions. We've done about just a hair over 1.7 billion transactions, currently have 1.4 billion assets under management. So Eric has been an integral part of building the PassiveInvesting.com portfolio. So let's dive in. So I want to actually start off with what is the sensitivity analysis. So let's get just a little bit of definition. And of course, I cruised past my definition in the Y screen really fast there, guys. Well, there you go. End of the presentation. Hopefully you guys were paying attention. There you go. We're done. Okay. No, in all seriousness. A sensitivity analysis is the method that takes into account, it's an analysis, like you should see a grid within the offering memorandum. If you don't, ask the team that you're the operator that you're investing with. We always put it in our offering memorandums because we think it's super important for the limited partner to visualize this. But it takes into account, it's an analysis that takes into account several different factors that would impact the investment's returns, the property's returns, and helps you understand the impact of each of those factors on how it would affect the profits, okay? Now I'm going to show you a grid here in a second, and then we're going to put this into play here. But why is it important that you understand the sensitivity analysis, like what it is and just how it's calculated? It's because each one of these variables, that's what they are. They are a variable. If you change any one of them, you actually will visualize, create a different outcome in range of returns that you're looking at. So what we tend to look at, like generally the cap rate is the variable that we generally will, has one of the greater impacts that could change the internal rate of return on the asset that you're seeing, and potentially the equity multiple as well. Now, cap rate is not the only thing that can be manipulated. Remember, there's other things that go into calculating the cap rate, right? Even those small manipulations there, changes in that particular, like say the net operating income, can impact the analysis as well. Guys, I'm having problems with my little arrows today. So I pulled this sensitivity analysis from one of our previous decks. This is a multifamily deal, a while back. And as you can see here, this is what, how we help our investors visualize a sensitivity analysis. And so, in this particular deal, the entrance cap rate was a 4.2%. But we've helped our investors, if the market does get better, they can see that, the IRR increases, the equity multiple increases, that's the returns upon disposition increase. But we also want to understand what happens when the cap rate expands. Should the market soften or get worse? What are the potential returns of that asset? Now, again, this is like helpful to understand, but I brought Eric on here, one, to add to any of the things here where we needed to expand, but also show you the inner workings of how one of these tables gets developed and how it can be really simple for a potential operator to manipulate even the sensitivity analysis. And I also wanted to show you how we are doing this very conservatively here at passiveinvesting.com. Awesome. Eric, I'm going to pass it over to you.
All right. Am I good to share my screen here?
I might need to give you the power. Give me a second.
There we go. Can you see it?
There yeah.
Perfect. All right. So this is a sample deal, not a real deal. So if you see like an interest rate at 3% or something that is not necessarily what we're seeing in today's market, that's why it's not a real deal. But it's a good example, and we can kind of walk through what some of the different metrics are, how we look at the sensitivity tables when we're underwriting, and what you should be looking for as an investor. And this is also not the underwriting spreadsheet that we use as well. There's a lot of man hours that was put into that, our actual workbook. So this is kind of a template as well. So we'll start with, as Whitney was saying, one of the more important things is going to be that exit cap rate. So if you're looking at a deal, and for example, this deal, you can see the trailing cap rate right here. And Whitney, please stop me at any time if I need to zoom in further or whatever, because I can't really see it on my screen. On the trailing cap rate on this deal, we're at a 5.25. And you can see our LP IRR is at 10% and our LP cash on cash is an 8.5. So as an investor looking at this deal, if you're looking for cash flow, you're like, wow, this deal looks great. If the operator is somebody you like and you trust and you might say, wow, this, year one, I'm already getting a 6% return on my cash. By year 5, I'm at a 9.5, and throughout all those years, I'm in the high 8s. So this looks like a great investment to put my cash, but it's something important to understand what the levers are that are putting out those returns. Your outputs are only as good as your inputs. So if you see a nice shiny, pitch deck with a 25% IRR and a 15% cash on cash on a multifamily deal right now, there's definitely some questions to be asked about what are some of those assumptions and how is that operator getting to those numbers. So it's important to understand kind of what is going into these numbers and how to read the returns when they're being presented to you. So as I said, this deal right now, we're buying at a 5.25 cap rate. If I go into some of these sensitivity tables, again, we're made for example purposes, but a terminal cap rate we have here on the left side. So I've underwritten this deal at a 50 basis point expansion. So we're going in at a 5.25 cap rate, and we're exiting at a 5.75. So that's basically meaning we're expecting the market to soften a little bit. Maybe rates are going to go up, or there's a lot of supply coming online, or whatever may be happening. And we just want to be a little bit more conservative with our exit cap rate. So it's important to understand what's the current market cap rate in your market. So right now in this hypothetical market, in this hypothetical deal, we're saying 5.25 is a fair entry cap rate for this type of asset in this market. And our exit cap rate, we're expecting to raise 50 basis points off of that. So you see highlighted right here is our 10.1% IRR from the inputs page. And this also has a sensitivity up top on annual rent growth. So if inflation, if we're back in 2021 or 2022 and inflation is going crazy, and we even saw 20%, 30% rent growth in some pockets, but say we're at 4% rent growth over the hold period and we exit at a 5.75 cap rate, that brings our IRR up to a 12.5 instead of a 10. So all these things will change the returns, and it's important to understand some of the major assumptions being made in terms of rent growth, cap rate, vacancy. So down here we have annual rent growth versus stabilized vacancy rate. We have stabilization time versus hold period. We have terminal cap rate versus hold period. So like if you see down here, if the cap rate ends up actually not changing, maybe the market even gets a little better down to 5% cap rate, and we see stronger rent growth at 3.5%, our IRR is at 16.2. So just a good visual of what the exit cap rate can do, what annual rent growth underwriting can do. Right now, you're probably anywhere from 0 to 3%. I definitely wouldn't go above 3%. And I think if you are underwriting 3%, there should be a pretty strong, support behind why you're underwriting 3% rent growth. Is there a supply and demand imbalance? Is it a kind of a burgeoning market? What are some of the reasons that you're underwriting 3% in today's market? Because we're seeing obviously rents slowing down a little bit across the whole country. So I'll pause there. Are there any? I see some. Are there any in the Q&A that we can hit before we go to the next table, Whitney?
Yeah, so I think it was from the example that I showed before. How is the cash and cash the same in every scenario? Is that a question good for now, or should we table that one for later?
We can table that one, and maybe we can bring back up your nice presentation there to answer that one.
Okay.
But basically, what that sensitivity table was showing is an exit cap rate sensitivity alone. So we're not looking at any changes in cash flow. Basically, all exit cap rate is going to do is impact your IRR. So that's why I think in that specific example, there was no change to the cash, just the IRR.
Got it. And I guess I have a question here, how do you, with all of the, the various inputs from your other screen, right? It picks out all these different potential scenarios. How are you reconciling all the different scenarios together in order to put together share what's important to share with the limited partner investor?
Yeah, I think it's it's really trying to look at this exit cap rate primarily, because that is going to have the largest impact in terms of your exit and the return of capital and the returns that you get upon exit. When we look at things like rent growth or vacancy and things like that, we always try to be more conservative than what some of the data is telling us. And we always have an agreement and a conversation and calls with our property management company, FCA, to make sure that we're looking at all the comps in the area. We're looking at the supply and the demand. We're looking at the new deliveries, and making sure that our underwriting for rent growth and for vacancy are below market in terms of being more conservative. The exit cap rate is not under our control, really, when we're looking at deals. So that can change more fluidly in terms of exiting a deal or operating a deal when your vacancy and your rents are under more of your control, not necessarily all under your control, but that exit cap rate can fluctuate in a day if something happens. So it's important to understand. I think that's kind of the main metric that we want to look at.
Okay, so show the investor the metric that would probably have the greatest impact, but also is slightly out of the control or largely out of the control of the operator. And if they're okay with those range of returns, or help them visualize those ranges of returns. And if they're okay with that, then fantastic. And this might be a good investment for them. Is that kind of fair to say?
Yeah, yep, that's perfect.
So how are some ways that you've seen a sensitivity analysis be manipulated for bad instead of good?
I don't know that I've necessarily seen it, but I could definitely understand how people could manipulate the numbers a little bit. I think one thing is just not showing one at all. So if somebody, like I said, hands you an investment OM that says, hey, our IRR is going to be 15% and our cash is going to be a 6%, and that's just is what it is. It's important to understand that those numbers, especially the IRR, are not able to be completely controlled by that operator. So if anyone's telling you that this will be the return and there's going to be no variance in that, I don't think is a truthful statement. And so making sure that you're understanding the ranges of returns and why the ranges are being presented in the way that they are, and just understanding the economics. And I know Dan and Danny just wrote a book that's really good in terms of really understanding what to look for as a limited investor, a limited partner investor, and it talks through all of these different metrics and what you should be looking for, and it's a pretty comprehensive book, so I'd probably recommend that. I don't know, Whitney, if you're grabbing yours, but I've got mine right here as well. Shameless plug, but it is important for all limited partner investors to fully understand, not to the level that a general partner, a partnership needs to understand, or the actual operator needs to understand, but at a high level, be able to kind of look at an investor OM package, understand what the different levers are, how they're coming to their returns, and making sure you understand that even if a 25% IRR is presented to you, understanding that it's really all about the inputs, and that's just a cell that takes information from other cells to get you that number.
Awesome. Guys, if you're here live, I would love to know what questions you have. Drop them in the Q&A box. We would love to get those answered for you. Eric, one question came in from Carlos. Do you use a static discount rate for long-term operations? Now, that isn't necessarily something that our limited partners need to know, but I'm curious. I'll ask you the question anyway.
Yeah, we do. It's important to look at different discount rates, but generally we look at a static discount rate for our hold period. Yes.
So let's define what that is for people who are here, like just shaking their head. They're like, what are you guys talking about?
Yeah, so it's basically the price that you're paying for an asset if you were to pay all cash at the kind of current date of the investment. And if you're looking out into the future, what return could your capital be providing you if you were to kind of invest in another asset class or another investment vehicle? So what discount rate are you applying to the time value of your money for the next 5 years? And so that's, I think, a good way of explaining that.
Awesome. What are some mistakes that you see? And I know you're more on the operational side of things, but what mistakes do you see limited partners make when they look at this data? Are there like assumptions that they're making here that get them in the hot water? Is there, anything that we can kind of arm the limited partner with as far as like how they should be digesting this data?
Yeah, I think, I mean, we talked about the exit cap rate. I think understanding what the vintage of the property that you're buying is and what the entry cap rate is. If you're being presented a Class C deal in a tertiary market, that entry cap rate should be a lot different than a Class A deal in a primary market. So, today that Class A deal might be in the mid to high 4 cap rate range. And then that Class C deal in the tertiary market should probably be in the 6% or higher cap rate range. But they still should be applying a little bit of expansion to that cap rate if things get worse and the market softens and debt continues to get worse. So understanding the vintage and in that kind of asset class that you're looking for, I think, is important.
Yeah, and I think you bring up a good point there, and I can flip back. Did you have more to share here, Eric?
No, I can stop sharing it.
We can flip back to that other screen, maybe. I gotta back out here. I think when I work with investors, one of the things that I see investors make, and you kind of alluded to this, is that they look at the entrance cap rate and they always want to look at it with rose-colored glasses, like, oh, look at this money that I could make if the cap rate continues to compress, right? And really, and anybody that's been on the phone with me, I'm pushing you to look at the numbers going the other direction, right? Because we want it, that helps you risk mitigate. Like, okay, if the cap rate expands, how does that impact your returns? And are you okay with that? Because this is a longer hold investment. Would you agree, Eric?
Yeah, definitely. It's important to, like I said, understand the business behind the OM and the operator and everything like that. Because these, like I said before, these numbers are just results from other inputs. So it's important to understand kind of what's behind a lot of these.
Well, guys, we have made it through majority of our educational material today. We picked apart the sensitivity analysis. Eric showed you on his nifty spreadsheet, just like how the different inputs like impact the different analyses and how that is put together into a nice pretty table and dropped into the offering memorandum. We are going to be on here cleaning up any of your questions that you have, so make sure to drop those in the Q&A box. But for those of you who are joining live, and if you haven't done so already, make sure that you're joining our passive investing club. You can join through passiveinvestingwithwhitney.com. You get some extra goodies there. I just want to say thank you and taking the time not only to be here with us today, but investing in yourself and your knowledge, so you can go into your next deal with confidence. And Eric, thank you so much for showing us the sensitivity analysis.
Yeah, thank you, Whitney.
Yeah. We'll hang out here a couple minutes longer if you guys have more questions. If you're listening on your favorite podcast player of choice, thank you for joining today, and we'll catch you next time.